Thanks for tuning in to Bloomberg Quint. I'm Navneet Saluja, and with me is Yatin Mota here, and we are in conversation today with Gautam Duggad of Motilal Oswal. We will be discussing his recent reports. One of them is value migration, which is basically a strategy on how to pick winners in disruptive times, and also his recent report on the rural theme as to why he is so bullish on that. Gautam, thanks very much for joining us today. First up, I want to discuss the value migration theme, on which you've written a very detailed report where you've said that you could pick winners by focusing on this strategy. Tell us, what exactly is value migration?
Sure. So just to give you a bit of a background on value migration. See, today we are living in literally disruptive times. One after the other, new disruptive events are happening. You know, it started with asset quality review of RBI, which was not heard of a couple of years back. It was followed with demonetization. Then it was followed with RERA, and now we are in the midst of GST. So when so many disruptions happen, there is a lot of shifting of value will take place. And there is a very detailed study which was done on this theme globally, where they discuss about various themes of value migration which have spanned out in the last 4 or 5 decades in big global markets like US. Correct. So what we have tried to do here is we just applied that theme to India, and we just highlighted around 10-12 case studies where value migration is already in play, and some cases from a futuristic angle where we think value migration will play out. So essentially, what is value migration? It's just shifting of value from one business model to another business model.
So basically one company to the another, or
it's
even
from one sector to other sector, one country to other country, within a company from one segment to other segment,
so
and even within a
sector.
Yeah, I mean, there are various types of value migration. It happens because sometimes the existing leaders or the incumbents, as you call, are not able to satisfy the evolving consumer needs. And there are new players who come in and who actually try and satisfy those consumer needs, and consumer then shift from existing leaders to the new set of players, and that is how value migration takes place. From a market point of view, it gets reflected in the market capitalization. Right? So when you see a very predominant shift of market capitalization, say for example, the public sector banks to private sector banks, it started way back in 2005-07, right? Sometimes the market cap shifts happen much earlier, much ahead of the profit shifts. So in case of public to private sector bank, it started somewhere around 2007 when the market cap shifted in favor of private sector bank in the overall scheme of things. But the profit shift happened much later in 2015. And we think that while it has already happened for the last 8-10 years, it's a theme which can play out for even another decade or so.
So Gautam, let's talk about value migration, keeping in mind Indian markets, which a lot of people in the street are of the view that the valuations could be stretched. If I were to take last year's EPS, which was hovering about 438, markets at 10,000, we're trading somewhere about 22 or 23 times. If somebody had to apply this value migration in the current scenario of Indian markets, which are the top themes according to you where one can look or park money for the next 2 to 3 years?
Sure. So the beauty of this theme is that this theme works for a very long period of time. So the value migration in IT sector lasted for almost 2 decades, from the global markets to the Indian IT players. It happened in pharma for more than a decade in favor of Indian generic players. Today, both those sectors are finding themselves in a bit of a challenge. But nobody can deny that in the last decade and a half, or 2 decades, we have seen very massive value migration happening in that sector. Similarly, today, as you speak, there is a very overarching theme of unorganized to organized trade shift, which will happen, which is nothing but a subset of the overall broader architecture of value migration. So what we have enlisted in our report is there are 3 buckets under which we have highlighted the case studies. One is from unorganized to organized. Second is the value migration which can happen because of lifestyle changes. And third is value migration which can be unleashed because of technology. So when I say unorganized to organized, there are several sectors which encompass that theme. One of the themes that we are very hot on is the jewelry sector, where the theme is very much in play because of what the government has done in the last 2-3 years. There is a clear-cut move towards more transparent businesses, right? The scrutiny levels have gone up. Now, when so much change is happening, obviously the trade will shift in favor of formal players, organized players. Who's the beneficiary? Companies like Titan will become a big beneficiary of this theme, because today also unorganized is 78-80% of the overall jewelry trade. And our view is that in the next 10 years, next 5-10 years, this 80% will shrink and make way for the organized players.
Titan was one of those rare companies which benefited from demonetization.
It's already, it's the only company in my view in the non-BFSI space which has seen big benefits coming out of demonetization. We've highlighted the same theme in adhesives, where the market share of the incumbent is already at 65-70%, and unorganized guys are going to shrink again going further. Then again in home finance, for example, there is a very niche theme. We are bullish on home finance as a theme, but within that we are more bullish on segments where the financing is done for self-employed segment. Because those are very niche areas where competition cannot easily come in and disrupt, because the skill sets which are required for credit appraisal in those kind of segments are very different. In case of, for example, some of the themes that we've highlighted are even bordering sectors like commodity, sectors like logistics. Why I say commodity? I mean, there is a big global theme, which is big global shift which is happening from steel to aluminum, given the emission norms and overall density. So, I mean, value migration can happen in any sector. It's just that one has to keep their eyes open. And other thing to remember always in value migration is, unlike a typical business cycle which lasts for 3 years or 4 years, and therefore it becomes very essential to time that cycle. Because if you are late in a business cycle by a year or two, then you lose those gains. In value migration, even if you are late by 2 years, 3 years, because the theme, the duration of this value migration shift is for decades and 5 year, 10 year, you can still afford to be a little bit late. Ideal thing is, of course, you identify it much before others. But even if one is late in identifying that theme, you still end up making money. For example, in PSU banks, if you had missed that trade in 2007 and let's say you entered that trade in 2010, even then you would have made tons of money in the last 5-6 years. So in today's scenario, I have no doubt in my mind that sectors like consumer, sectors like auto, sectors like private bank will benefit big time from this theme of value migration. In auto, we have seen a very big change, segments like 125cc and less than 125cc market motorcycle, those have made way for premium motorcycles. Right. So things like iShare 5-6 years back, they were nowhere. The kind of wealth they have created, it's amazing. Right. Even in cement, if you see, just look at the total architecture of market cap of the cement sector. Shree Cement in the last 10 years is up 17-18x. Whereas the big incumbents, the other big guys, they've not given similar returns. Why has it happened? Because one player was able to extract disproportionate value out of the sector because of certain niche advantages which they created. So value migration can happen in any sector. It can happen for a long period of time, and at the same time there are losers also. So for example, when we talk about energy sectors, we are clearly seeing that the preference for energy is shifting from thermal to renewable. So players like BHEL could find the going tough for some more years.
And talking about this value migration or so-called organized, unorganized theme, do you think demonetization and GST both have been a catalyst for the businesses moving from the unorganized sector to organized sector, or do you think people have turned more brand conscious, or it is to do with lifestyle, or this organized players, the benefits that they get because of the positioning they have in the marketplace, that is where probably the disruption will help them?
No, so see, the disruption would have happened irrespective of demonetization or GST, because the whole complexion of the economy is changing. You have an aspirational consumer who wants high quality products, who has been exposed to Western media, so his style of consumption is changing across sectors. Right. The way he's consuming media content is changing, the way he's consuming branded products in the personal care space is changing, in the food space is changing. What demonetization and GST has done, it has given a big push, it's given a big tailwind to that eventual shift which would have occurred any which ways. Right? Lifestyle changes, I mean, this is how exactly the things have played out in the other developed economy. Things like diagnostic services, things like airline, railway to airline is a big value migration. Right? So things like media, physical to digital content, again, is a big theme. Today you do not have many investable plays on that physical to digital media content, but it's going to happen, right? Some of the segments where the value migration is happening is even in unlisted spaces. This whole trend towards Ola and Uber is nothing but value migration. Right. So players like Maruti today, they are growing at 10-8% volume growth. 10 years down the line, one needs to really think whether this 10%, 8% growth rates which one puts in a DCF model for terminal growth rates, for volume growths, will they last or will they shrink significantly? So there are several segments where this value migration is in its embryonic stage. One needs to take a very hard look at that, whether this will sustain or not.
And talking about your latest rural India strategy report, I was just looking through a few pages, and the companies or top rural ideas that you mentioned in the report is Mahindra and Mahindra HUL, Hero Honda, Colgate, all of these companies having market share anywhere between 40 to 50%. Do you think the rural portion of the country is probably at an inflection point, be it monsoon, be it government focus, especially when we have a government which has 2 budgets left? The talk is that the rural expenditure will rise substantially. What is your understanding of the subject, and how do you think all these companies will benefit?
So the reason why we wrote this report today is because we have seen in FY14 to FY17 for 3 years in a row, rural consumer was literally sleeping, right? The rural consumption had literally stagnated. Now after 2 consecutive years of monsoon, normal monsoon, last year also we had a normal monsoon, but then we ran into demonetization just when consumption was picking up. Now again you have a normal monsoon, so 2 consecutive years of normal monsoon, couple that with 5-year high MSP price hikes. MSP price hikes are 5-6%, which on an absolute basis looks low, but it's the highest in last 5 years. And also you need to view this in conjunction with the significant moderation in inflation that you have seen.
Right.
So it will put more money in the pockets of rural consumer. And thirdly, the whole trend of farm loan waivers. I think this farm loan waiver trend can accelerate as we move into calendar CY18 when you have spate of state elections. And then the point that you mentioned, that next year the government will try and pump prime the economy just before the election. That's the hope and that's the assumption. And also this year itself, government has put a lot of money in the rural sectors. So government spending in rural areas, be it irrigation, be it roads, be it Narega, has gone up this year.
Right.
So all of these factors put together, and then you add the flavor of low base of demonetization of last year. Companies which have a very significant rural positioning, which have higher share of revenues coming from rural markets, they should benefit in our view next year. Already we are seeing commentaries in this quarter from various companies like M&M, companies like Mahindra Finance, Lever, even Colgate, Dabur, all of them have pointed towards significant or rather possibility of a significant pickup in rural consumption, which is why we are relatively more bullish on rural consumer plays this year compared to last 2 years.
It's also very interesting, Yatin, because 70% of our population lives in rural area, whereas if you look at the contribution to GDP of theirs is only 30%. That's where people are betting, because government is also spending, putting more money into rural areas, and things like farm loan waiver is in a way disruptive because it's increasing disposable income at anyone's hand. So tell us, talking about this entire theme, would you like to share some stocks with us in that theme which you feel could be multi-baggers in the next 2 to 3 years?
See, looking at multi-baggers from 2-3 year perspective, it's very difficult to foretell.
You take your own time horizon.
Right? Multi-baggers are never predicted in advance, right? They happen, and then you realize it's a multi-bagger. Predicting multi-baggers when you are sitting at 10,000 Nifty at 20% average premium, and even within Nifty and even within BSE 100 you have several segment of stocks which are trading at a significant premium to their 5-year, 10-year averages. But sectors, segments where we are very positive even now, as I mentioned in the beginning, is private banks. We are very positive on select NBFCs. We are positive on autos. We are positive on consumer discretionary, things like Titan, things like, today consumption is not restricted to just FMCG. The definition of consumption has become much more broad-based today. So there are things like media, things like auto, things like jewelry, QSR, consumer electricals, durables. A lot of those spaces have opened up in the broad category of consumption. So those are the segments where we would be much more positive on a structural basis. Having said that, in the near term, I think sectors where the valuations have beaten down significantly, sectors like IT, sectors like pharma, sectors like telecom, metals, industrials, utilities, these are all sectors which have not performed for last 2-3 years. There is a very strong possibility that you may see some pickup there. I'm not saying things are changing fundamentally there, but the sheer fact that the flow of negative news, if that were to abate, that itself will provide a kicker for those stocks to bounce, at least in the short term. But from our point of view, from a 3-year to 5-year perspective, we think sectors which are more exposed to domestic economy, sectors which are more exposed to consumption, and even something like private bank or some of the NBFCs will benefit from the whole consumption theme that we discussed. So those are 3-4 sectors where we think still money can be made from a longer term perspective. But I think from a 1-year perspective, it's going to be very challenging to earn a double-digit return from current levels unless you see a significant earnings surprise. So far, the returns that we have seen have largely been driven by PE expansion, which happened because the cost of equity has fallen, because the interest rates have gone down, and globally the markets have been benign, plus we have been a beneficiary of big inflow of capital from the domestic side. Also, this year we have seen almost $8.5 billion in the first 6 months from FI side, which is more than the FI flows of CY15 and 16 put together. So a lot of external factors plus internal factors have combined to drive the markets. It is not yet driven by earnings. It's still there in hope, it's still there in expectation. But when the actual earnings materialize as predicted, it has not happened for the last 5 years. But if you see FY18 seeing a 10-12% kind of an earning, or if you see December quarter, which I think ideally will be the first quarter which will be normalized quarter after the last 3-4 disrupted quarters that we have seen. If December quarter earnings on a normalized basis are looking good, then possibly you can see more upside to the markets. But you need earnings surprise now for the markets to move further from here.
Neeraj and Navneet were talking about how metals are turning around. If you look at China data, they have a lot of steel capacity shutting down. Iron ore prices are moving up, aluminum prices are moving up. In fact, today Hindalco came out with its units earnings, Novelis, and they had given a strong management commentary. So on the metals pack, do you think probably we are looking at some short-term positiveness which is there in the marketplace, and China is driving that particular market?
See, the trick with cyclical sector is always to invest when things are depressed, sentiments are depressed, and try to book your profits or move out of that trade when things are looking very buoyant. Right? A year and a half back, if you remember, March 16, nobody was willing to touch the metal stocks or commodity stocks because China, there were concerns about oversupply. Crude was at $27 and all stocks were beaten down, sentiments were beaten down. Now from that point of time till today, which is August 2017, this 15 months period that you have seen, stocks have given excellent returns. Whether it is Tata Steel, Hindalco, Vedanta, any stock you pick. I would be a little more cautious from these levels.
So would you recommend booking profits there?
I would be very happy to book profits where I have made enough money in the last 1.5 years. Because with metals, with metals or any other cyclical stocks, it always pays to be cautious when things are looking too buoyant, and if you have entered at the right time, then it makes sense, even though you do not make the last 10% or last 20%. I'm not saying that the rally is behind, but I think Tata Steel from 175 to 620, 630, if you want to enter now, and obviously the kind of valuation risks that you are taking are significantly higher than you would have taken had you bought a year back.
Right. And what about the markets? We have almost 50-60% of the Nifty companies already come out with earnings. So far, if I were to ask you about a scorecard in terms of earnings vis-a-vis the valuation at which the marketplace is trading, how do you see the things shaping up? And as a head of research, what are you advising to your clients at this point in time?
So today, if you see markets and earnings, the two are disjointed. Fundamentals and the valuations today are not looking very convergent. Okay. And one of the reasons obviously is the whole decline in the cost of capital that you have seen. So your numerator, which is the earnings, has not gone up, but denominator, which is the discount rate, has corrected. So therefore, you got an uplift in value. And secondly, the liquidity. You've seen massive liquidity. Even July yesterday, there were a lot of media reports talking about July being the single largest month of domestic money flow. Right. So you can't fight with that kind of liquidity with the traditional tools of valuation. Right. So and market has always been like this. When it moves up, the pendulum always goes to the other extreme. So today we are in that kind of a scenario. But now you step back and look at the parameters which typically characterize a market pick. Compare today's market with the market of 2008. Okay. It's not looking like a bubble kind of a valuation. You are at 19 and a half times on a forward basis. In 2007-8 you are at 24 times. And that time your cost of equity is much higher. Today your cost of equity is much lower. Today you are not sitting at 90%, 85% capacity utilization in industrial sector. You are at 73, 74. Right? That point of time things are very different. Private capex was booming. Our private capex cycle has not yet started. Right. Secondly, today the macros are the best that you can imagine it to be. Twin deficits are under control, inflation is under control, currency is stable, capital flows are very strong.
So everything is looking nice and
macros is very strong. It is not yet converting into micro.
According to you can derail this rally? Then let's see earnings do perform in the coming quarters. What are the other factors?
Then I think the only factor, and it sounds cliche, but only factor which can derail the market is the global factor, right? Okay. What happens to the Fed normalization of balance sheet? What happens to the Fed rate hike cycle? If you get some kind of a surprise or geopolitical tensions, political tensions, those are the usual cliche concerns that people have. But realistically, if you think today where you can go wrong is that, let's say instead of FY19, you do not see earnings recovery even in FY19. Right. Then people's patience with the earnings will run out. Sure. Today things look as if FY19 should be a year of earnings recovery year. but we've gone wrong in the last 3 years in a row predicting earnings recovery. So till the time the corporate commentaries do not turn positive in a very broad-based manner, this quarter, if you listen to the corporate commentaries, they're very mixed.
Yeah.
Some sectors are talking about earnings recovery, some sectors are talking about rural segment picking up, but private capex has not picked up. Asset quality situation has not changed materially. So therefore, in this kind of an environment, you will continue to see the same 2-3 sectors driving the earnings and pushing the markets higher. You will not get broad-based earnings recovery. And it will take, in my view, it will take at least another 3-4 quarters before you start seeing a bigger and better earnings recovery. So till that time, you will struggle with valuation. But given that you are looking at a backdrop of cost of equity which is much low and fund flow which is much stronger, it will continue to frustrate people on valuation terms.
Okay, so that was the house of Motilal Oswal talking to Bloomberg Quint, and they see some value in the rural market, wherein they expect a good monsoon to be a booster to the rural demand. Of course, the disruption that they're talking about could benefit the BFSI space, largely to do with private banks and the housing finance space.